Saving for a down payment to buy a house is one of the biggest challenges most people face. But here's the thing, with the right strategies, you can overcome those challenges that can fast track your savings. So in this video today, I will be sharing how much down payment do you need to buy a home in Canada and what government programs you can take advantage of that can help you fast track your savings. So I will be breaking this topic in two parts. In the first video, I will be talking about how much down payment do you need and what's the down payment structure is. And in the second part of the video, or in the second video, I will be talking about the government programs in detail so that you can take advantage of those. And if you get any value out of this content, then please smash that like button. And most of the viewers of this channel have not subscribed, so I would really appreciate if you can subscribe to the channel. And if you got any questions about real estate, you can book a call with me by clicking on the first link mentioned in the description below. Now, without wasting any time, let's talk about it. So first, let's understand the down payment structure. Government of Canada recently changed the mortgage rules. So because of that, that has affected the down payment structure. So earlier, if you were buying a property worth 1 million or more, you had to put down 20% down straight up, no exceptions. But now that has changed, so I'm going to walk you through that. So if you're buying a property within the price point of $0 to $500,000, the minimum down payment required for that is 5%. And if you're buying a property more than $500,000 up to $1.5 million, then the minimum down payment required is 10%. So let me quickly run an example for you. So if you're buying a property worth $1.4 million, then you have to put down 5% on the first $500,000. That's minimum. So that if you're looking at is $25,000. And for the remainder $900,000, you have to put down 10%. So we're looking at is $900,000. So in total, if you're buying a property worth $1.4 million, effective December 15th, 2024, the minimum down payment required is going to be $115,000. Whereas earlier, you would need 20% as a down payment on the purchase price of $1.4 million. That is $280,000. Okay. So now I'm going to run an example at the lower price point just for easy reference. So I'm going to run an example on the purchase price of $600,000. So the minimum down payment is going to be, you have to put down 5% on the first $500,000. That's going to be $25,000. And for the remainder balance of $100,000, you have to put down 10%. So the total down payment required on the purchase price of $600,000 is going to be $35,000. So now let's go ahead and I'm going to run the number on a mortgage calculator. So again, I'm going to take the price point of $600,000 in Toronto, Ontario. The minimum down payment we just discussed is going to be $35,000. And if you put down 10%, it's going to be 60. And if it's 15 or if you put down 20%, the amounts are mentioned over here. But the main difference is if you put down a down payment less than 20%, then you have to get a CMHC insurance. The reason being is because this way, as a buyer or as an owner, you have a low equity in the house. So the banks wants to protect themselves. So in that case, you have to get a CMHC insurance, which you have to pay. And if you put at 20%, you don't have to get that. Okay. So I get this question asked by a lot of my clients that what's the ideal down payment? Is it the 5%, 10%, 15 or 20%? I mean, or even more. So, I mean, it really depends upon your personal situation, to be honest, but I can give you my personal thought on this, that my personal opinion would be the more down payment you can put down, the better it is, because this way you'll have less exposure to debt. First of all, your monthly payments will be slightly lower and you don't have to get mortgage insurance. For example, on the screen, you can see if you put down a down payment that is a 5.83 on the purchase price of $600,000, you have to get a CMHC insurance of $22,000 give and take. That gets added to your total mortgage amount. That's quite a change. And at the same time, I do get a counter argument on this, that how about if someone who has collected 20% down payment, they only put down 5% towards their property as a down payment, and the remainder balance they invest in the stock market or S&P 500 or whatnot, so that from those appreciation of stock market, they can service the mortgage. I mean, sure, you can do that if you are very super strategic and super disciplined about it and you're stock market savvy, definitely. But for me, for example, I am not that stock market savvy, so I don't think so that's going to work for me. So basically what I'm trying to say is it really depends from personal situation to personal situation. But my opinion would be to get rid of the mortgage as soon as possible. That's the end goal, so that ultimately you can live mortgage free. And one more thing I forgot to point out is that if you put down a down payment of 20% or more, you slightly tend to get a high rate of interest as opposed to in a situation where a mortgage is insured. Because If you put down less than 20%, in that case, you have a CMS insurance. That way, bank are more secured. So that's why they tend to give you a slightly better rate of interest as opposed to when you put down a higher down payment. So the difference between both the rate of interest is not too high, but that's something I thought I'll share with you. Now let's go ahead and talk about how much mortgage room you can actually get. So let's talk about that. So to know how much mortgage room you can get, I'm going to use this website called ratehub.ca. It's pretty user-friendly website. I would definitely vouch for this. So let's run an example. So let's say your annual income is $100,000. And I'm assuming that you're putting a down payment of you're putting a down payment of $50,000, and the city we're looking at is Toronto. Then if we check out how much mortgage room we can get. So if you're someone whose income is 100K, whose annual income is 100K, and you're putting down a down payment of $50,000, so the house you can afford is at a price point of $481,000. So that's not much because we don't get much in the city of Toronto for that price point. Maybe a small studio, maybe if you're lucky, maybe one bedroom in the GTA area. But the game changes over here if you maybe do a joint venture, maybe buy it with your spouse, partner. So that's where things get a little better. So your income I've put as an example is 100K, and your spouse or someone with whom you're doing a joint venture with, I'm going to put their income, or I'm going to assume their income to be 100K as well. Down payment in this case, I'm taking it as $80,000 in total, and the city we're going to put is Toronto again, and I'm going to click this. So in this scenario, you can get a house for $943,000, and if you put a down payment of $80,000. These are just approximate numbers. Typically, you are able to get 4x of your salary. That's the 4-factor rule. But I would definitely suggest to speak with your mortgage broker or mortgage specialist at the bank to give you more in-depth numbers and more correct numbers. Alright, so that was all about down payments, and now in the following video, I'm going to talk about government programs that will help you to save for down payment. So stay tuned for that. I'm going to upload that video soon.